And thank you and welcome to this lecture session. This is a part idea of India compulsory foundation course. I hope you all know that. Only thing is that because of the sort of broad kind of interest in this topic, we thought that we would open it up for some more people. So I think I can see a couple of our colleagues from FMC. Am I audible? Yeah, okay. So thank you for joining us. So, so it is my great pleasure to introduce Professor Partha for a lecture today. Professor Partha, let me give you a quick sort of run through about his career so far. He did his PhD from Bombay University, and then he joined RBI, and he was in fact the director of the Department of Economic Analysis and Policy at RBI. He was with RBI for many years, and then he went to the International Monetary Fund as the advisor to the executive director, covering the areas of, if I remember correctly, India, Bangladesh, Sri Lanka, and Bhutan. Right. So he was there for 3 years, I think, and then he joined Indian Institute of Management, Calcutta, as a professor of macroeconomics, and he was there for, again, about 10 years. Recently, he has joined the National Institute of Bank Management in Pune, which is basically an institute set up by the RBI as its director. So I'll just say a couple of things about Dr. Ray, which I find very interesting. One is that, first of all, he is, a prolific researcher. He keeps on whatever he is doing, whether he's in an administrative position or not, he keeps on publishing papers. The second thing about him is that he can work with practically people from any field. I think he has worked with people from political economy, he has worked with people from scientific areas and so on. So, we talk about interdisciplinary research and all that. He's an example of what you can do there. And finally, he does not just engage in, abstract research, which only a few people can understand. So he also regularly writes for many newspapers and tries to make himself accessible to the population at large, try to communicate to them, and so on and so forth. So, so we will have the lecture today, and at the end of the lecture, given the time, we will take some questions and from the audience, right? So over to Dr. Partha.
Thank you. Yeah, I think I can say that. Am I audible without the microphone? Yeah, so I understand. You can keep it here. Professor Sen, what he didn't mention, that Professor Sen was my teacher. So whatever I'm going to talk today, if there's anything wrong, you blame it on him. for things that those are right, of course, I say. Thank you very much for assembling here today. And I understand that between you and your lunch lies, hopefully that we will have some questions. What I'm going to talk today is basically a current issue. We look at a little bit of pandemic. I'm no virologist or epidemiologist. I'm sure, in a medical school, I'm giving a talk for the first time physically, and global growth and global equity market. And we'll discuss, we'll point out that there is some disconnect between them. We will try to look at the disconnect and essentially look at it. So we'll talk of the basically what generically called the Wall Street and the mainstream. Then we'll come to the global growth, global long-term trend, the pandemic, recent trends, and then we come to the irrelevance of the Main Street to the Wall Street. Now, these two words, Main Street and Wall Street, will be referred to generically. So Wall Street does not mean a physical street in New York. Main Street, of course, doesn't mean either. It's essentially the financial market and the real estate. And then we will narrate the story with respect to some US Fed announcements. So first, let's look at the relationship. Those of you who are in economics would appreciate that you often write a production function, an aggregate production function. Y is an output, is a function of K and M. And you also have, I mean, even if you have not, from other disciplines, you have not exposed to this particular elementary functional form, you know there's a notion of capital. Now, what exactly capital? The way economics look at capital is machines. And then later on, people from endogenous growth like Paul Romer and others extended it further and to make it human capital. But move where the word finance comes in. Capital does not mean money or stock or anything else. It essentially means machines or human beings who have certain education in them, who have turned themselves into human capital. So there's no role of financier in that sense. Okay. Now, here, what's the relationship between finance and growth then? The typical, for want of a better term, I'll call it the finance wallahs, they think finance causes growth. Martin Miller was arrogant enough to say that financial markets contribute to economic growth is a proposition too obvious for any figure discussion. End of story. But then there are others who think finance follows growth. And there's only where you get to see a leftist like George Robinson and an ultra-rightist like Robert Lucas saying the same thing. So they said wherever enterprise leads, finance follows. And somebody, Lucas, said, the role of finance has been overstressed. So just finance does not make growth to happen, so we are not very sure. In other words, I start with this collective confusion about the role of finance in economic growth. Moving further, so what's the interrelation? So basically the way one second, sorry. How do I go back? Yeah. Yes, I got it. Yeah. Interrelations we have seen, the countries with better developed financial systems tend to go faster. But that's like, that's like countries with better developed financial system are also better developed. So it's part of the larger story. So this is the third factor that's there. And of course, if there's better access to capital, financially constrained firms can expand that matters for growth. So in all these stories, later on, what we distinguish between what is called a bank-based finance and a market-based finance. Think of this way: when you want to have a new house, you go to a bank. Share, got it listed into Mumbai Stock Exchange for your housing project? Perhaps difficult, isn't it? So there are cases when you go to the market, and there you need this intermediary called banks. And often this bank-based finance therefore plays a major role. What we have seen, various measures of financial development show positive correlation. This same correlation has been emphasized by various other people, Raghuram Rajan, Luigi Gingales. They worked on this and they found out finance, typically if you have financially constrained firm, it matters a lot. How global is finance? Interestingly, finance is scale neutral. If I export 10 of this to US or 1 million of this to US, That means I will need that many boxes more. So that means I need more shipping power. But to send $1, $1 million, and $1 billion will take the same nanosecond per click of a mouse. Therefore, remember, finance is hugely scale neutral. Therefore, the notion of supply chain will not be applicable for finance. So it became hugely global. One of the things it became hugely global is because of this country called the United States, where the ratio in total GDP, the share of 4.5 is finance, insurance, real estate, and leasing. So 1/5 of US GDP comes from finance. Any guess what's the number for India? Any guess? 10, 15, 5, 20, any guess? You were surprised to know the that number for India is roughly comparable in terms of share. In other words, because Indian economy has become hugely service oriented, and in service orientation, financial firms, whether call it banks, call it NBFCs, call it foreign hedge funds, all these play a major role. So that's the reason for which we have got. Despite this, there's an interesting feature of financial services. It's called home bias. Home bias refers to the fact that other things remaining same, an American will buy an American. Indian tends to buy an Indian share more than an American share. This despite the tom-tomming of globalization that you tend to get this particular phenomenon of home bias. There are reasons for home bias. There could be explicit implicit regulation that restrict investment. You may not know there are transactions costs associated with foreign investment. And then investors may not have full information about the foreign assets. And contract enforcement is a peculiar problem. You do not know how the New York state of law is functioning. The similar American may not know why the Indian court takes so much time. 96 to 2016. What it shows, of course, it moves up. Each time there is a counter, the recovery time is becoming lower and lower. 19 years, 25 years, very high. It became 16, it becomes 6. Something happened in between. The recovery period of the stock market has become lower and lower. And this has been hugely interesting in terms of long time series data. It became lower and lower. Why so? That in some way, despite we all know that the clamor for marketization, government intervention to save the financial market everywhere. So one of the reasons is this is shorter because government intervened. And that's the story we are going to say here. So I'll skip this. Basically, therefore, what's the role of finance? It's like up, and that's how, but per se it doesn't matter. For example, think of this. Suppose in this university you have a fat fee to pay, unless you have an admission to the university, just the education. So getting an admission is a prior notion before you get liquidity constraint. You might take a bank loan. After the education is over, you earn that and pay it back. So essentially what you are doing over your lifetime, you're optimizing. Not one period, but both as student and as a job. So both the period you are going to do it, so that now you borrow and later on you pay it back. But per se, therefore, finance doesn't matter. Let me take a break here and go through the global economy. It's a completely independent story. Then we'll try to make them together. At this juncture, an interesting thing, we do not say there's something called underdeveloped. The politically correct word has become emerging market and developing countries. Now, there is a group of advanced countries which are 39. Who determines them? IMF, World Bank, WTO, all these things together, they determine it. And how is it determined? Primarily, this is the baggage of history. Primarily, this is by the company it keeps. So in other words, Greece is part of EU, and therefore Greece is an advanced country, whereas China is not an advanced country. China is part of share. So it's 39 versus 150. Their share is increasing. So there has been some sort of a tectonic shift in the economic power over this period, which can roughly be termed as a globalization, 1990 to 2019, that these are becoming important. In particular, the share of like within this 30 years, their thing has become trebled. And this is who are they? They essentially mean three phenomena. First, in 70s, East Asia, in 80s, China, and 90s, India. So these three, please, legitimately, you can be happy that this is 1/3 of global GDP is by emerging and developing Asia, which means Asia minus the advanced Asia, namely Japan, Taiwan, Korea, Hong Kong, Macau. Asia minus these countries are called developing Asia. Now, how has been, but here you see at this juncture, for example, India is the 5th largest economy with a GDP of 2.9 trillion. So when the Prime Minister said India has to be 5 trillion economy, he was referring to this. Now, this is what GDP at MER. MER stands for market exchange rate. So how to find out? Suppose India's GDP is X rupees, rupee dollar exchange rate is 70, so X by 70 will be India's GDP at MER. Here, India is 5th largest. Be happy, but don't be arrogant. If you look at it, it's 1368 million. So if you divide the GDP by this, per capita GDP, India is roughly a $2,000 per capita GDP. As against United States, which is 65,000, as against China, which is 10,000. So that's how you realize you should look at both. Yes, India is the 5th largest economy, but an average Indian, in terms of pure arithmetic mean, their per capita income is roughly $2,000. Now, from here, you'll be surprised to know, and there you see the power of finance. You'd expect looking at this, that the currencies of these countries should reflect accordingly their importance. So US definitely the first, then China, then Japan, then Germany, and then Indian currency. That does not. Essentially, in the currency market, there's a term called G10 currencies. G10 currencies are essentially these countries. And look at it. This is the share in the total foreign exchange transaction share of each currencies. So their US dollar share is 44%, Euro 16, Japanese yen 8.5, British pound 6.5, India does not appear, Chinese renminbi is 2.0. So in other words, dollar is not great because American economy is great, but American economy is great because dollar is great. In other words, the causality when it comes to the currency market leads to something else. The phenomenon which has been termed as exorbitant privilege. Or Ben Bernanke recently has said why people accept dollar. He referred the term as network externality. So I accept dollar because I know Professor said will accept dollar. So since I do, he does that, therefore it becomes universal. So that's a currency market is entirely different. This is very little to do with GDP, is to do with your power in the market. This is here that I just take another short pause and discuss very little on the pandemic. You all know it, just I'll summarize the broad trends. At this juncture, yes, there's a major one. COVID cases could be something like 263 million, deaths 5.2 million, and vaccination is the only last thing. If you look at the history of earlier pandemic, one thing is established, that this has been a major pandemic. Even in terms of history, you see, it's no joke that you have 5 million deaths at this juncture. You have even earlier flu pandemic, 1 million, Asian flu 2. It's only purely early. You see, huge number. So in some sense, this is of course global health crisis, is it? It shows limitation of modern medical science and also public health facility. In some sense, this is a story of the pandemic. Now, what do we hear? End of the day, this is a tug of war between innovation of medical sciences and innovation of the virus. And that's how you tend to see that there's clearly number of peaks is in terms of weekly cases, in terms of weekly death. Fortunately, there has not been peak, and the story lies there, the vaccination. This was a broad story we all knew. And as I said earlier, the silver lining is definitely vaccines. We all feel very proud that India's number of vaccine has really exceeded huge number. But again, percentage of population, we are something like 26, 30% around that. Okay. This context, I'll come to the recent growth trend of global growth. Think yourself as, I'm giving this talk exactly in 2019. So if I give this talk, it was nice. This chart tells you the story of global growth. It shows the earlier downturn was 2009. That was the global financial crisis, started with Lehman Brothers, American subprime crisis, and leading everything. Now, there are two messages that comes from the picture. The first is the top guys are the emerging markets and developing Asia. These are the top guys. So again, the moral of the story is we pull the global growth. But does not mean we alone can do it. We all move up together and come down together. To me, this particular chart tells me the power of globalization in some sense. That they all move up together and come down together. Now, we are unfortunately not in 2019. We had the pandemic. And as I said, if I take a purely narrow view, how did it lead to economic loss? First, loss of human life per se is huge loss. Especially the health costs, there can be three parties who can pay for it, either you or your insurance company or your government. There's no other third party. Excepting these three parties, somebody has to pay for it. There's no prevention. The lockdown and therefore food supply has been going down. Global supply chain is affected. You have low demand out of low income. If people have got pink slips, people lost their jobs, the informal sector suffered. Corporates are hit adversely. Initially, there was gloomy mood in the financial market. Banking sector hit adversely. There was huge burden on central banks. So everywhere, people suffered, and this was a hugely expensive in terms of economic loss, apart from loss of human life. Now, when you look at, I'll skip this. If you look at the growth rate, you look at it first. This is 2020. This is a 40-year low. One, this is 40 years for which we have good data. If you look at the earlier, less reliable data, but reasonably okay, then you realize since World War II, this is the lowest growth rate. We have not seen such a thing. We have not seen such a thing. And the interesting thing there has been shared by everyone. These are the new numbers released by the International Monetary Fund in October. You see, 2020, everything is minus, excepting low-income developing countries, very small, and a country called China, which is plus 2.3. So excepting China, all other countries suffered a contraction. The GDP failed. That's a major thing. You expect in 2021, the economy will rebound, but that's a function of whether you get a new wave or not. And please understand, these numbers are over and above these minuses. Therefore, in terms of compound growth rate, they'll be very, very low, and you will need at least 3 years before you come to the pre-pandemic levels. And this is precisely what it shows. If you take this is 100, and this is minus 3.3, 96, 6%, 102, 4.4, 107, the compound growth rate will be something like 1.62%. So in other words, we have a genuine adverse shock, not for 1 year, but it takes time. Assuming no further trouble, it might take 2 to 3 years to rebound. And the unfortunate part is, it is becoming a tale of two worlds. Whereas the advanced countries only income group, they expected to return to pre-pandemic trend by 2020, 0.9. All others, even by 2022, this is minus, depending on the pre-pandemic trend. So we will need, as I said earlier, 3 to 4 years. Around this time, there's one more bad news. Inflation is back. Why inflation is back? Because you have all those lockdowns, you have people losing their jobs, and therefore there's a huge supply side story, and therefore inflation has started going up. So in other words, you are bad news on both the fronts. Growth is down and inflation is up as well. And therefore the central banks are somewhat helpless in order to control this inflation. So I have looked at a little broader trend first, then the growth story, and then the inflation story. We have looked at it and a little bit related to the pandemic. Now from here, the standard story that you often hear is this thing called the K-shaped recovery. In other words, there's some part who are in the top arm of K and some guys at the bottom arm of K. I'll give you just two illustrations. In a year back, 2020 December, the market capitalization of a company called Zoom, which I'm sure you have not heard of 2 years back, was more than the aggregate market capitalization of 7 largest airline companies. Imagine Zoom versus 7 largest airline companies. So that's a difference. So Zoom is here, airlines companies are here. Even within the same company, it might lead. Illustration, Walt Disney's entertainment park business was here. Walt Disney's online content was here. In fact, they surpassed their 7 years of projections. So something has been fast forwarded at the same time. So you get to see a K-shaped recovery. If you get to see a K-shaped recovery, the natural implication will be inequality will be up. So those of you who have heard of Piketty, the Piketty process will be really back here because you have got a K-shaped recovery. It is in here. Let me bring the Wall Street. Now, first, there's a very interesting slide. This shows Dow Jones and this shows BSE Sensex. First, if I don't tell you and if I delete this, would you be able to identify which chart belongs to whom? They actually look like a mirror image, entirely mirror image. Now, then the interesting part is they were down in February, early March, till they started opening up, started going up. What happened in March? Was there a new vaccine? Did the death rate come down? None of these things happened, but they went up and up. In general, things were up. And this is not only in Dow Jones and India. I have looked at various other indices like Euro Stocks is Europe's index, S&P 500 is America, MSCI emerging market is number of emerging markets, and TOPIX is Japanese. They almost are mirror image. They move up together, they come down together. So globalization, at least in the financial market, is actually an established fact. That we now know. Now, interestingly, if I plot this side, USA S&P 500, and this side number of deaths in the US, they look like almost like a perfect correlation. What does it mean? The more deaths and the stock market went up. So we, in another paper, me and a co-author of mine, from this chart, we call this phenomenon as festival of death. Are you so cynical? The stock market has nothing to do with this. Remember my earlier discussion on finance and growth? It looks as if they don't matter at all. This is going up, people are dying, and the stock market is going up. This is exactly the thing. So there was something else there in the picture. It is here that I bring the story of the global policy package. Global policy package, by which I mean three things. The fiscal policy, that is the government spending, what they do it in Delhi. Monetary policy, the RBI spending, what they do it in Mumbai. And structural policies, various other things has been done. For example, there may be some kind of, NPAs could be allowed for the time being. They may be doing something, for the salaried class, there may be some more incentives to do. So all these things together, this chart is from Mckenzie, which shows we have spent much more now than the global financial crisis. So this is a much more major crisis now as against the global financial crisis. That was a basic thing that you tend to see. Huge policy package. And just look at this chart. This is total assets of the US Fed. This was around 4 trillion in 2019 December. Within a year and a half, it surpassed 7 trillion, which means something like 7 minus 3, 4 trillion extra money has been injected by the US. And you understand that this money is fungible. It's not that all money is there just in the US. This money can go anywhere. US, after all, is an advanced country, is capital account convertible. Therefore, this money can come everywhere. So just in a year, around 4 trillion extra liquidity has been pumped in. And the broad story that we establish, that the large chunk of this liquidity has gone to the financial market, added to speculation. So in other words, this is the classic case of what Alan Greenspan said long back, something like an irrational exuberance. Okay, also apart from this huge fiscal stimulus, this is fiscal balance. So the world fiscal last year, 2019 was 3.9, 2020 is minus 12.7. That means total global GDP around 8% additionally has been spent. So who spent it? The government. The government can spend only in two ways. Either they can tax you or they can borrow from you. Now, in a year like this, they cannot tax more. So what they can do, they can only borrow from you. So the huge amount of government borrowing has gone up. And this has long-term implication, so much so that the right side of this chart shows the general government gross debt. So that is something for the world. It exceeds 100%. So the difference between deficit and debt is sum of all deficits. So debt is the stock and deficit is only with respect to the year. So for some countries, for example, like Japan, this is 264%. Now, should you infer the Japanese economy is heading for an imminent crisis? This is here you realize, since Japanese yen is a convertible currency, there are people who are ready to hold Japanese bond. It's like between you and say think of Mr. Tata, who is more indebted. Mr. Tata is more indebted. I'm sure you will agree with me. But that's because his creditworthiness is more. So similarly, those 10 currencies in the global world, their creditworthiness is more. They can get enormous amount of money without necessarily having a crisis. But if our country, if the countries in the emerging markets have this kind of a thing, then they are going to face difficulty. That's the basic problem. Moving the story further, they have taken enormous actions. I'm just discussing, not going to discuss them, but just see how they have done. So what do you expect? When governor of RBI prints another rupee, what is it backed by this? So rupee is a liability of the RBI. It must be backed by something. What could it be backed by? What's your guess? No. What would it be backed by? Okay, think it this way. Think it by. So suppose you have got a 100 rupee note and there signed by Shaktikanta Das, RBI governor, I promise to pay the bearer the sum of rupees. And you happen to meet him in a shopping mall. And you show him that here you have promised me, here there's a note. So please honor your promise. What he's going to do? He will give you another note, 100 rupees. Remember, that's the power of fiat currency. That's the power of fiat currency. It represents the power of the state behind. So end of the day, a central bank can take anything under the sun as its collateral. For example, in India, the primary thing is not World Bank, but primary thing is Government of India securities, Government of India bonds, plus number of other reliable foreign currency bonds. So that's how, and US has done anything. They have taken commercial paper, they have taken primary dealers loan, primary market corporate credit, Main Street, municipal liquidity facility. Municipal liquidity facility, in other words, Government of India, suppose RBI can take a debt paper issued by Bangalore Municipal Corporation. That'd be wonderful, isn't it? But it will go up, it will increase the money supply. In India, we can't afford it because not many people are ready to accept rupees. So your dichotomy between the currency market and the real sector GDP market comes in here. So US Fed has done this, similar ECB has done this. These are the details I'm discussing. What essentially is happening, if you think of the broad things, government, households, firms, rest of the world, and financial markets, and market for goods and services here. Lots of money is being churned within the financial markets. They are not going out of the financial market. They are not going out means they are not adding to any further productive capacity. They are not adding to any further GDP or output. This within the financial sector. They exist for themselves. So why this is? Who matters? One of the interesting results we have shown in a couple of papers is, to tell it actually bluntly in a politically incorrect way, is RBI does not matter for Sensex. But US monetary policy matters for Sensex. In other words, why? Two reasons. One is purely the FII channel, the foreign institutional investors, they are active in Mumbai Stock Exchange. And second, and in some way more fundamentally, that defines the sentiment. I'll remind you, you may not remember those things. 2015, when Raghuram Rajan just became the governor, between April, May, June, July, rupee moved from something like 58 to 68, 55 to 68. The rupee dollar exchange rate moved from 55 rupees a dollar to 68 rupees a dollar. Why did it happen? Mr. Rajan did not do anything incrementally right or wrong. He maintained the status quo initially, It happened because Ben Bernanke said that I'm going to taper off the rate at which I'm buying securities. This second derivative. In other words, the US Fed are going to buy securities, but at the rate at which they are buying, that rate is going to be little slower. This sentiment has been interpreted by the financial markets in the United States that US has become a land of mutual money and therefore withdraw money from countries like India. And they called them those things as flight to safety. Give me a break. It was essentially flight to familiarity. So given a chance, they would be investing only US, but because these markets offer them an astronomically high return, therefore they come here. The moment they get a pretext, they take the money out. And since it's a FII money, foreign institutional investors' money, these are hot, they move in and they move out. Everything very fast. So US quantitative easing genuinely influences Sensex. And just look at it, and that will give you a sense of Piketty, in his famous book Capital, has mentioned one thing called, look at, he said R minus G. R is a return from a particular market, financial market in this case, and G is the growth rate. If you look at the higher is the R minus G, higher will be the impact on inequality. So if you look at R minus G, these are hugely high. I mean, India, this is 74. So the rate of growth, the rate of return by investing in Sensex minus the growth rate is 74. What does it mean? It means along with lower growth, this is going to be accompanied by a huge increase in inequality. There's other impact we normally don't think, because this impact will be reflected after 5, 7, 10 years. This has a longer term perspective. So I know just for the completeness, Mckenzie gave a different view. They said stock market could take a long run perspective. Overall exuberance may camouflage the micro sectoral stories. And they said many sectors like construction, professional services are not included here. I don't buy this, because irrespective of what has been happening in the real sector of the economy, the stock market is moving up and up and up. And the clue to that is because of huge liquidity coming in, and this liquidity is not going into building of a productive sector. This liquidity is essentially going in terms of financial market, therefore people have. Okay. Why this is? One of the things is the interesting literature called Sociology of Finance, where in a couple of people, at least I read this particular paper, Cetina 2013, who said traders thereby provide liquidity to the market and sustain it. In other words, traders act as custodian of the market. Traders are the market. So forget SEBI, forget you as investors. End of the day, traders are the market. And they fulfill bridging and liquefying functions when gaps arise and activities seem to gel, and then also try to revive markets when they break down. Although banks can limit traders' losses and volume of instruments they can trade, traders are not constrained by any of the bank's views on the development of price movement, but instead develop their own stance of instrument that they trade. We have not emphasized enough the interest of the traders in terms of economic policies. And therefore, a huge high liquidity by various central banks, whether it's Fed or European Central Bank or Bank of Japan or Bank of England or RBI, everywhere huge churn of liquidity has ended up in some form or other. In India, the case is much less because banks have restricted. But all these other markets, all the other countries, there's a huge emphasis for investment, and therefore that's what happens. So end of the day is a question, isn't it bubble in the stock market? To me, at least it appears, seems to be. But do I know when the bubble will burst? No. Had I known it, I would have made much more money going there rather than giving a talk here. No, of course. Is the stock market around the world more integrated? Yes. irrespective of the real sector integration via trade, the financial markets are much more integrated. And you have seen those things. Is it driven by balance sheet expansion of several central banks? To me, this is a very, very strong thing. And therefore, whatever happens, technically, if you ask me how long the central banks can do it, how long they can. Bernanke was asked this question when Bernanke, the US Fed chairman, and he said technically up to infinity. Because you are not questioning the central bank. Because Mr. Das, the RBI governor, has the power to give you back the what you say. That's the power of the fiat money. That's the power of essentially the state in creating the money. In the financial sector, number of people have started saying there may be too much funds in the financial sector. But remember, this US economy 1/5. Remember the parallel number for India. Because of this, finance have in selected countries have come to be very, very important, and therefore they rule the roost. I think to conclude, does finance matter for growth? Yes, and possibly no. The role of finance, as I said earlier, is like lubricant in a machine. It improves productivity, but it alone cannot produce, but it can create a huge amount of bubble otherwise. Stop here.
Okay, thank you very much, Professor Ray. And now I think we can take some questions
and you can ask any question. Remember, there's nothing called a silly question. However, the answers could be silly occasionally.
Good afternoon, sir.
Good.
So my question is, when we see I'm getting it from the Social Sciences Department, MA Public Policy. So my question is, so when the government announced the demonetization earlier, then we
have discussed demonetization. We can ask it, but I thought your question will limit it to the.
So the government has opposed and wrote a letter that don't do it. And when the Ujjit Patel was then RBI governor, I said nowadays. So my question was, is finance ministry is intervening more with the RBI rather than leaving it as an independent body?
Interesting question. Let me give the answer upfront. Now look, this whole body of independence of central bank is funny. End of the day, please to remember, whether you like it or not, a government is elected by popular votes. A central bank governor is not elected. So you assume demonetization may be an awful policy, but it was presented by an elected government. RBI may have a technical discussion, but I have not seen the technical discussion coming in the open. Dr. Rajan's so-called letter came up after he resigned. At that point of time, suppose next day central bank governor resigns. Next day this comes to a limelight. That could have been different. When you say in retrospect, it has different effect than when you say when you're actually in the policy. You understand what I say?
Any other questions?
Good afternoon, sir. Thank you for a very stimulating lecture. I have maybe a very silly question, but you showed that table of R minus G, and you said that it indicates some inequitability. And there India was at 73. But your last column then showed US, and I saw a figure of 75. So what does that indicate?
Don't take these numbers purely in terms of 75 higher than 73, because these are not statistically significant. I've not tested whether they are different. This only means these are large. These numbers are large. Therefore, when the overall economy is not doing well, when the stock market is doing well, that means wealth is being created with the people who are investors in the stock market. In other words, within the whole population, what would be the proportion of Indian stock market investors in population?
Not sure, but maybe a very small percent.
Therefore, those small number of people have got the benefit in a year when rest of the economy is going into talks.
So you're saying that the same thing would have happened in the US also?
Yes, exactly. Exactly. Same thing, and therefore, in the years to come, we would expect large inequality to come in unless government takes corrective steps. And there are steps being talked of. But for example, President Biden has said taxing the super rich. But this has been said in American economy for at least for the last 3 presidencies. None of them actually tax the super rich. And it's a known fact, the super rich pays much less tax rate-wise than the so-called mediocre, so-called Joe the plumber, as Obama used to say. He didn't do it. I mean, that's a very interesting question. Now, you may not be aware of Kaldor-Pasrinetti model. So let me first explain to you that in the Kaldor-Pasrinetti model, you have normally economists are remarkably institutional. I mean, their knowledge about institutional things are very poor anyway, and they have all kinds of formalization. So they have one representative individual. So we do not know whether that guy is rich, poor, good, bad, indifferent. So Kaldor-Pasrinetti, they at least talked of a 2-sector model, rich and poor. So there, the interesting thing was, who will spend more, the rich or poor? Who will consume more, the rich or the poor? Consumption, the poor will consume more out of their proportion. I mean, if I spend 70% of my income in consumption, Mr. Ambani will spend 2% of his income. Therefore, a redistributive policy in favor of me will generate a much more multiplied effect. Since I'll be buying a shirt, the shirt owner will be buying, say, buttons, and button owners will be buying, say, threads. So a multiplied effect will be operational. Now, in Kaldor-Pasrinetti model, therefore, a redistribution generates the growth. In this case, people have I think people have forgotten Kaldor-Pasrinetti. Piketty did not say Kaldor-Pasrinetti directly, but Piketty at least made a reference to Marx's surplus value creation indirectly, and therefore says that when you have big R minus G, there will be adverse conditions in the economy for the poor.
Thank you, sir. We have one participant who is participating over here in online. His name is Mohammed Kamar Azma, and he said that explain why stock market increased during COVID-19. According to him, it is due to disposition effect. So he wants an explanation from you.
Disposition effect.
Yes, he has mentioned this.
So disposition means people got poorer.
Poorer, and there is a effect which has given them social and economic disbalance in their life. So that may create a disposition in the stock market.
That may be an impact, but that's not cause.
Okay.
That's maybe an impact. So to which the answer is, this what he says could be an impact, but not a cause. Because these people, if you are, suppose, let me explain another important thing. What's the relationship with Wall Street and Main Street? It was very clear that the Main Street does not matter for Wall Street. It doesn't matter what's happening there. It has its own momentum. As I said, financial institutions, huge amount of money being churned within them. But on the other hand, for Main Street, the Wall Street matters in an asymmetric way. Why were we affected during the global financial crisis in 2007, 8, 9? We had no exposure to this. But because the Wall Street in the US plunged, therefore European market plunged, therefore Indian market plunged, and therefore there was a total bleak sentiment in the market. So the other way matters. For the Main Street, Wall Street matters even if I do not have a single rupee of stock market investment. I still might lose my job. There's a power, there's a negative power of stock market. It can generate huge amount of inequality. In case of a boom there, and in case of a bust there, it might lead to your loss of job.
There is a question.
So I have one.
Yes.
You had a slide where you were explaining the tale of two words.
Yeah.
That the developed countries, they want to go to the positive end of 2022. So what is the message or significance?
Again, inequality. That's exactly. It's like this. Think of it. I mean, this is a bad metaphor. So pardon me for saying this. So somebody has a heart attack. A healthy person, there's a higher probability for a healthy person to fight back than a weak person. One, and there's also a probability for the rich to fight back, provided the rich is healthy, because at least has a wherewithal to have this. Essentially what I'm saying, the developed country can fight back within 2 years. They have got back to the pre-pandemic level. But the emerging markets will take 4 to 5, assuming no further shock. Assuming there's no new variant of a virus, assuming there is no inflationary shock. So these are two big assumptions. Right now, we do not know. You, me, WHO, none of us know what they're going to be, the new variant will look like, what is their impact. There are all kinds of stories. Similarly, we do not know if the inflation comes back. Because if the inflation comes back and RBI starts increasing the repo rate, then that's two bad news together. Two bad news together, because on the one hand, the inflation is up. On the other hand, when RBI increases the repo rate, your borrowing is more and more expensive. So if borrowing is expensive, you will not undertake that activity. If you do not undertake that activity, growth will further suffer. So there are two bad news together, could happen. I'm saying could happen. That's an interesting question.
The other from this, have a query regarding that India is the most, if we see, is the largest in the gold consuming market.
Second largest.
Second
First is China.
And does our this gold as a metal contributes valuation in Indian currency? Because when we see about this Indian currency, it's not there in G10 currencies because of the inequalities or the maximum number of population is living or they belong to the middle class population.
No, I'm sorry, but just I'll take that, then I'll answer your full question. I'm interrupting you here. The Indian currency is not there in G10 because India is not a great financial power. India is not a great financial power globally. Globally, there are 4 currencies matter. Pound sterling, dollar, euro, yen. These 4, apart from those other 6 in G10. So that's not true. But ask your question.
Does this valuation of this, how this valuation of Indian currency will go on? It will increase in terms of gold as a metal if it is there not in our home and if it is there in RBI. Is this one, or it will be like this, that now the government is giving gold bonds? That is also an application where the people will give much more shares and that the stock market will increase. So for this aspect, I just wanted to know if we should keep gold in our own pocket or we'll just give gold to the RBI. And that may increase our currency value.
Interesting question. Let me make 4 to 5 comments. First, let gold as an investment opportunity lose its sheen. In other words, in some sense, this yellow metal is reasonably worthless. 1, reasonably worthless as a central bank asset apart from a dire crisis. In normal period, nobody matters. normal period, amount of gold does not matter. The signature of the finance minister, signature of the RBI governor will do, because that signature is backed by the state. The state of India, similarly, the dollar is backed by the state of the United States. So the state, accepting a huge crisis. In a huge crisis, for example, 1991 crisis, it mattered because nobody was ready to give us loan, and we had to hypothecate loan to Bank of England. So in that period, it matters. All over the world, the amount of gold holding is quite low because you can generate either the government security or some reasonably good foreign securities in terms of their currency backing. Excepting US, because US is a country which is the ultimate, like Atlas. They're keeping the whole art on his shoulder. So US is a Fort Knox story, and there's a huge amount of gold there. But apart from that, we don't need it except in a crisis. Now, coming to Indian thing, there are two separate demands for gold. One demand for gold is that of ornament. Informal estimates like 40% of that. A quiz. From which country India imports the most gold? From which country? Any guess? It's Switzerland. It's Switzerland because Switzerland as a country produces most number of 10 kilo bars. So gold become an investment asset. Why? Suppose I can take a currency position and go to a State Bank of India and say, my salary, let this amount be kept in dollar, this amount is kept in pound sterling, this amount is kept in yen, then my demand for gold will be less. So gold becomes an investment opportunity in a country where there is not much capital account convertibility, which means foreigners cannot invest in our market without restriction. There are restrictions have come less. So gold, yes, as an investment opportunity because we have capital account restriction, but otherwise, as in terms of currency backing, do not over-exaggerate its importance. And I'm not talking of the enormous amount of gold that Indian gods have. Yes, please.
These G10 countries look at cryptocurrencies and regulating these cryptocurrencies because I think it could be they have more value than the currency themselves.
I've written on this. I can refer to this. The last question. Okay, I've written on this. The term cryptocurrency is a misnomer. It should have been replaced by a term called crypto assets. You can make anything, damn thing, an asset. It did not have to be a physical thing. I mean, you know that in the peak of the crisis, not this crisis, 2007, 8, 9 crisis, there was a group of people called quants, where your tribe, the physicists, physics PhDs, have all written a contract which no normal human being will understand, but there's a huge derivative contract going on. There were CDO squares. That's fine. So crypto asset is fine. But when you call cryptocurrency, how many people are ready to accept? We make a group. So four of us make a small group and say we honor our IOUs. So I say I promise to pay Mrs. Sen the sum of ₹1,000, and she's accepting that, she's accepting that. But rest of you won't accept. Therefore, the notion of universal acceptability in cryptocurrency is not there. And therefore, when you can't beat them, you join them. That's how central banks are doing all over the world. There's a notion now called CBDC, central bank digital currency. That, if it comes, that will be a real cryptocurrency. But its shape and form, we do not know. Whether it will be an app from RBI, whether we all will maintain an account with RBI. In that case, what is going to happen to the banks? Will RBI pay us interest rate as a result of this? We do not know all these questions. So that right now, that we are grouping in the dirt. The days of cryptocurrency is over. The crypto assets might come.
So thank you, students, for your question and answers. And thank you, sir, for your detailed explanation about the latest topic.
Before ending and giving the vote of thanks, I would like to invite Professor Sen for giving or presenting the token of gratitude, along with, of course, Chetan sir, to give the token of gratitude from Ramaiah University of Life Sciences.
Thank you so
Thank you
much.
very much.
Yes. So I'll not open it. I'll show it. This is basically the Chenpatna toys, which are handmade
Oh,
and with vegetable colors.
oh, wonderful.
And they will be colors which will be for lifelong,
Oh,
unless you really tamper with it. So this is from Chenpatna, from near Mysore.
thank you.
And we have a small mug for you from the Ramaiah Public Policy Center, where we have the vision mission being engraved on.
One. Thank you very much.
Welcome.
Thank you.
So that you.
Pleasure. Thanks.
Sir. We are at the end of the so to make this lecture successful, there are a lot of people who are involved, of course. So first of all, I would like to thank Dr. Partha Roy, who come all the way from Pune and giving us and enlightening us this valuable lecture, enriching our faculties of growth and for that, I would like to thank faculties from other teachers from other faculties, the teacher from our faculties, our students, the team from MPP, Master in Public Policy, who contributed a lot in this and like to creating poster to publicize it. Thank you a lot. And lastly, I would like to thank our technical team, Mr. Lokesh and Mr. Ravi. Without them, I think this cannot be possible. This it's a wonderful. Without any hassle, we have completed this lecture. Thank you all for presenting here, and thank you the people who are sitting online and listening the lecture from our guest. Thank you so much.
Welcome.